Welcome everyone to another Maine SBDC webinar. My name is Kelsey Bearden and I'm with the state team right in Portland, hosted by USM. And today we have Maine SBDC at CEI Business Advisor, Raynor Large, who's going to be going over how to buy a business. So if you've ever considered buying an existing business to start your entrepreneurial adventures, he's going to go through all the steps, or most of the steps, and all the things you should keep in mind as you get started. I do have quite a bit of construction going on outside my home right now, so I appreciate your patience if some loud things occur or I suddenly mute myself, but we're doing the best we can. So we'll ask you to also stay muted throughout the presentation. But there'll definitely be time for questions at the end if we don't answer them along the way. And we have kind of a small group today, so feel free to unmute yourself at that point and maybe ask more complex questions. Raynor's pretty good at getting specific there. Any questions you have along the way, go ahead and stick them in the chat right below. Also, maybe introduce yourself. Let us know where in the state you're at. Maybe an industry that you're looking to get involved in, but definitely any questions you have along the way. I will be sending out a follow-up email later today that will include the slides, the presentation, which will have any links that are mentioned. Those are all clickable links in the slides, as well as a link to the recording. So we are recording today's session, and we do our best to record our sessions and publish them on our YouTube channel. So if there are other topics that you are interested in, go ahead and poke around there. They might come across something you didn't know yet. We also, just real fast, we also have a digital e-learning platform that we've been working on for the last couple of years. We have about a dozen e-courses on there, and now I'm doubting myself, but I'm almost sure that there's a buying and selling course in there. So I can double check that. But we do have several different learning modalities available to anyone who is looking for help with their small businesses throughout the state. So we are the Maine Small Business Development Centers, if you are not familiar, and we provide no cost to you confidential business advising. So any question you might have about small businesses, we could probably answer. And if we can't answer, we can find somebody who can. So we can't provide legal or accounting information, but we can connect you with a couple lawyers or a couple accountants and get you headed in the right direction. So if you are not already set up with a business advisor, there's a big orange button on our website that says request advising. Filling out that form is the fastest way to get into our system and connected with an advisor, but I'll include that link in my follow-up email as well, so you don't need to go searching for anything. Otherwise, I think we're all set to get started, so I'll pass it over to Raynor.
Perfect. Thanks, Kelsey. I'm Raynor. I've been a business advisor here at the state of Maine for about 5 years now. And prior to that, and on my nights and weekends, I continue to be a business broker, commercial real estate agent, and a financial analyst for the largest listing business brokerage in the state of Maine. So this is something that I'm very familiar with. I've brokered both buyer and seller side agreements. And at this point, I've done more than 100 different valuations or opinions of value for businesses throughout the state. So understanding value, how you achieve value, and then navigate the process of buying is something that I've really enjoyed learning more about through the years and continue to help different business owners with. So I know Kelsey mentioned that, to sign up for an advisor with the state of Maine. If you haven't, I encourage you to do so. 100% confidential. It's a free service that you've already paid for with your tax dollars. So take advantage of it. Most of our advising, most of our work is done one-on-one. That's kind of our sweet spot. That's what we enjoy doing. As fun as these webinars are, I'd much rather just have a conversation with you about where you are and how to move you to where you want to go. In that vein, it is being recorded and you'll get the recording at the end, but the chat's open. I try to pay attention, but I tend to get kind of excited and energetic and enthusiastic about what I'm talking about. So So if you do have a question and it's easier for you, just take yourself off of mute and interrupt me. If you have a question, I guarantee somebody else listening in has the same question. And if we can address that as it's still pertinent as we're talking through it, that makes a lot more sense to me than waiting till the end. So I know Kelsey told you to wait till the end, but I'm inviting you, just interrupt me. Let's have that conversation. So what we're going to talk about today, and I've included a bunch of slides in here, which we may or may not cover, but we'll talk about why buy, what's the advantage of buying versus just starting a new business, which we also help with, but isn't covered in today's topic. How to identify what exactly it is that you're buying. How are you buying it? What are common deal structures, or what are ways around some common hurdles that come up with the acquisition of goodwill or intangible value? What's it worth? Assessing kind of a value to negotiate, or whether or not there is value in a business as a going concern. Structuring the deal, and then we'll talk about kind of next steps, best practices, depending on where you are in that process. So why buy? I think that's a common question. It's something that we're seeing come up more and more often. Tired of working for others, keep what you kill mentality, right? Those are both things that also apply to the idea of starting your own business. You've been employed in an industry, you've been working at a specific job for a long period of time, and you work very hard for somebody else's money, right? Sometimes how it feels. And so the advantage of buying a business or starting your own business is that you are getting to create the equity that you then gain, right? Now, these latter 3 points, I think, are more pertinent about why the advantage to buying a business outweighs maybe the potential of starting a business. So one way to kind of think about this is through the idea of a lender, right, a bank, because it's rare that you're going to be able to buy a business with a cash purchase, right? And if you have enough cash to buy it, then you probably have a good attorney or a good accountant looking over your shoulder and saying, you might want to reconsider that, right? So starting a business requires a lot of different assumptions to be plugged in, right? You're creating the justification for a new market. You're explaining a demographic. You're trying to find and navigate a price point and a cost of goods and your overhead expenses. And all of those are unproven, right? It's an idea, and you're trying to prove that out, and it could work or it could not work. A business that exists has all of those assumptions and all of that guesswork already proven out. And all you're trying to do is say, okay, here's where the business has been and is today. Here are my strengths that I bring to the table and how they fit into this business model. And here's where the business can go, right? With that groundwork already established, and we'll talk about valuing that historic performance, but those assumptions are answered. You know the demographic, you know the price point, you know that there's a market. You don't have to invest heavily in advertising, right? It's there. So you're buying it, without all of that guesswork and uncertainty, at a point where that's established. And then what you bring to the table, your energy, your experience, your ideas, are able to take that and take it to the next level, to the real benefit. So one thing that's important to identify early on is what your relationship is with the seller, right? So a lot of the things we'll talk about is, this idea of you're buying a cash flow. And that's really valuable if you're buying from, an employer. So you're currently an employee buying the business you work at, or you're a family member buying a family member's business, or you're buying it as an owner operator and you plan on working in that job 40, 50, 60 hours a week, depending on your commitment level or the need. A synergistic buyer is slightly different, and we mostly will not talk about that. So if you have an established business and you're buying another established business, there's a slightly different process there, right? Because you're not interested in all of their overhead costs. You might pick and choose, but some of that's being absorbed. And you're really just buying the market share, the customer list, their footprint, maybe some of the employees or organizational structure. But a lot of that gets absorbed into yours. So, that idea of what is the value of that cash flow? Well, the cash flow is different because you're buying it for what it's going to be with both entities combined than buying it as it is. As a family member, as an employee, as an owner operator buying the business that you're going to work at, you're buying a job. And those expenses historically are going to remain as they have been, right? The idea of inertia, that overhead cost or your cost of goods margin has been that for the last 3 years. It's going to continue in that trend unless you do something to change it, right? Unless an outside force acts upon it. Whole concept. So with that in mind, you're really focused on that bottom line, the idea of the business as a revenue generating structure that can generate enough money to cover its overhead costs, cover the cost of doing business, and have something left over for you. And that's what you're buying, right? You're saying, okay, I'm buying this list of assets and the policies, procedures, employees, everything in place that utilizes these assets to generate revenue above and beyond the cost of operations. So to take a step back, one of the first things you'll look at when you're buying a business or thinking about buying a business is the tax returns. The tax returns are valuable because there's been a second set of eyes on it, right? An accountant has reviewed those and submitted them to the IRS. Or the owner has decided that they have the capacity to do that themselves and submitted it to the IRS. So there's at least that step of submission to a third party. And so there's some validity there. Could they be falsified? Okay, yeah, I won't get too much into that, but they're more reliable than an internal set of documents. If someone sends you a P&L from their QuickBooks, it's kind of worth the paper it's written. The tax return at least has that external review aspect to it. So looking at 3 or 5 years of historic tax returns is a great way to see the historic trends of the business, right? And what you're buying, keep in mind, you're buying what it is. You're not buying what it's going to be. You don't want to pay for what you're going to do to it. You're paying for what it has been. So all that historic information is your focus. Now, if you can take that and move it to the next level, that's great. That's the opportunity that you get to create for yourself. But if you pay for what it's going to be, the process of getting there becomes much more tenuous and difficult. So looking at that historic information, I'll talk a little bit about the income statement and the tax return in a moment, but look for continuity and trend. The idea of inertia. Is the business growing? Is it expanding? Are they controlling their costs? Are they making or losing money? Very simple, right? Are there large jumps that are unexplained? The last couple of years have been difficult, so understand, okay, did they receive a big grant or loan from the government, during COVID times, and have they recovered to pre-COVID performance, or are they still in recovery? Okay, that's a big distinction. Is there a large miscellaneous or other category that's unexplained, right? A lot of this, you can understand the seller's ability to navigate their business and control their costs. So the value of those policies and procedures really come through in their ability to explain that historic information and have continuity through those years. If they're looking at it with you and they're saying, I don't really know, okay, so what are you actually buying? If they don't know, how are you supposed to know? So one quick note there, right? So when you're looking at this income statement, this is what an income statement looks like, right? Sales, cost of goods, and overhead costs. 3 major parts. And a tax returns over a year, and it's everything that happened in that year operationally. It's the sales that they had, your cost of goods, which is one type of expense, and your overhead, the fixed cost, which is another type of expense. So overhead and fixed costs are usually a dollar amount. You think about them as rent, utilities, insurance, and they might tick up as a dollar amount every year just based on the lease agreement or the insurance policy. Your cost of goods is materials, ingredients, direct labor to create the revenue. So when you're reviewing historic performance, you want to look at your cost of goods as a percent of revenue. The idea being, of every dollar I sell, 60 cents goes out the door to ingredients and labor. And if I sold 200,000 one year and 400,000 the next year, my rent's going to be more or less the same. My cost of goods should go up incrementally, right? And those two things go hand in hand. So when I'm reviewing historic information, I want to say, okay, are the cost of goods in control and trending as a percent of revenue as they relate to the revenue? And are my overhead costs trending as a dollar amount, right? So recognizing that distinction and that relationship is very important to understanding, okay, are these costs being controlled or are they out of control? Are they very efficiently run or inefficiently run, right? What am I actually buying? Are all of these assets working together and in constant state of review and improvement, for incremental improvement year in and year out? Or is it just kind of a grab bag and some years are great and some years are bad? Right? Because that structure, those policies, those procedures, that organizational design should be apparent in the financials. If it's not, well, maybe that's something you bring to the table, right? Maybe that's an asset that you have, but that it's uncertainty is ultimately what it comes down to. If there's uncertainty historically, then what you're buying is uncertain, and you're taking a larger risk by paying more for it. So income statement, that's what a tax return shows, is kind of this idea of revenue, cost of goods, and overhead. By comparing year in and year out, we can then see those trends and make an assessment of whether or not this business is well controlled, and is it improving or is it going downhill? Right. Kind of just talked about this. So this is the income statement, those three pieces. The second financial statement to kind of be thinking about in the back of your head is called a balance sheet. Most of the time when you're buying a business, you're creating a new balance sheet. So your income statement, the tax return, primarily deals with the what your business is doing, what the business has done operationally. The balance sheet is what the business is, right? So if you think about it like a house, if my house is worth 400,000 in today's market, that's my asset, right? If I have a $300,000 mortgage on it, that's my liability. And my home equity is the difference between those two, $100,000. That's the balance part of the balance sheet, is that my asset is always going to be a combination of the liability and equity. The liabilities and equity equal my asset. So when you're purchasing a business, you're buying the asset, and it could be furniture, fixtures, and equipment, inventory, real estate, potentially goodwill. If the purchase price is larger than the fixed assets, you have a goodwill value there. That's your asset. Now, you have a liability if you take out a loan or the seller holds a note, which we'll talk about. And you have equity, which is what you paid into it, right? So that has to equal the purchase price. When you're creating a purchase price, you're figuring out how to structure it, right? And those two things balance. Now, one other way to kind of think about this is that this income statement that we talk about, that net income, the bottom line of your operating performance, the historic performance of the business, funds the balance sheet. That's what you have left over after operations, that little blue piece at the bottom, to either increase your assets, to pay down liabilities, that's what the bank wants to see, or to pay out to yourself as equity. The dream, right? No liabilities, your equity, or your assets are in a good place, and you get to take it all as an owner's trust. So that's how those two things kind of fit together. Now, when you're talking about a purchase price, the larger the purchase price, either the more equity you have to bring to the table, or the more debt there is, the more of a liability there is. And so then you need more net income to support that debt. So the operating statement has to be able to support the balance sheet, if not fund future growth. So when we look at that net income, right, net income is the starting point. It says, okay, here's what they've paid taxes on in the past. This is the bottom line of the business. Now, banks look at what's called EBITDA, EBITDA. It's equity or net income before interest, depreciation, taxes, and amortization. The idea being, okay, there are some ways that the old balance sheet has been structured to reduce tax liabilities or to support their balance sheet. And we're going to add those things back to get a future cash flow. So EBITDA is basically the cash flow of the business to support debt and pay down the balance sheet. So a bank wants to see EBITDA. Now you, the buyer, want to see what's called seller's discretionary earnings. That's taking that free cash flow to the next level. So seller's discretionary earnings starts with EBITDA, and it also adds back the salary that the owner has taken in the past, the seller has taken, and discretionary earnings, discretionary spending. It's a bit of a gray area, right? The discretionary part should be non-operational. It has to be demonstrable, has to be provable, and it has to be legal, right? There are sellers out there who will say, well, 30% of my clients pay me in cash, and that never quite makes it to the books, but trust me, it's there, right? If it's not provable, then there's no value to it. Don't buy that, right? Or if you do, if you're in a situation where you trust them, the bank's not going to lend to it. So the seller is going to hold the note, and you should make that seller note contingent on some performance. They're saying 30% of their revenue goes missing, then make that seller note contingent on a 30% increase in sales. The seller shouldn't have any problem with it if they're saying that's where the cash is going. The bank will be fine with it because it's in a tertiary, fourth position behind them, uncollateralized, and you want to make sure that you're protected. You don't want to overpay, right? So this idea of the seller has taken some cash out of the business for a vehicle, company vehicle. Okay, great. Some training. Maybe they paid for themselves to go to college for a little bit. 401k match, health insurance. Maybe they have their spouse on the books, and their spouse does 10 hours of work a week and gets paid $60K a year, right? So those are kind of discretionary. They're not contributing to the operations. It's a choice of the seller to kind of expense some things through the business. Legal, their accountants sign off on it. It's right there on the tax returns. It's demonstrable. They've proven it. But you might decide you want to spend that a little different, right? So that would be considered discretionary. I don't need a vehicle. I live next to the location. I already have my MBA. I don't really need to expense college tuition. I don't have a spouse who I'm going to pay an exorbitant salary to do nothing, right? So you can add those back to get to this idea of SDE, seller's discretionary earnings. The concept being, what cash is the business producing? Income statement, now we're talking. With those kind of expenses through here, in those line items, and how much is that net income really? How much will you have to support the balance sheet, to pay yourself the wage that you need and pay the debt that you're adding to it, right? So this idea of what they're selling is their discretionary spending, their salary, the net income, the depreciation and interest that they spent on their loans. And what you're buying is the ability to support debt on your balance sheet, the ability to pay yourself a reasonable wage, which is entirely up to you, what you are looking for, and this debt coverage ratio, which the lenders want a buffer there. Right? If you have $100,000 in cash, the lender is not going to extend you a loan that requires $100,000 annual payment, because if you have to replace the coffee machine, the lender doesn't get paid. Right? So the lender wants usually a 20%, 25% buffer in there to say, okay, we can absorb some hiccups and still pay the principal and interest. So what is this actually worth? Right? So we've gone through this process. You've looked at the historical information. You've said, okay, with these adjustments and these add backs, the business is actually producing $120,000 on average over the last 3 years in seller's discretionary earnings. What is that worth? And how do you determine a value for that? So I usually use 3 ways of looking. right? So a ceiling value would be to say, what would it cost you to go and recreate this business down the street, to buy new furniture and fixtures, to restock the shelves and buy new inventory, to hire people off the street, to run, at a loss for a period of time and get to break even and compete with the seller. If you're looking at it and the seller is insisting that their business is worth $500,000, and for $100,000 you can get the same furniture, fixtures, and equipment, and start a competing business down the street, well, you still come out $400,000 ahead, right? You can absorb some loss and run at a deficit for a period of time and still probably do better than the purchase price of $500,000. So I would say the first thing I would say, the ceiling value is, what is that alternative? What would it cost you to go start a new business or buy another place? If it's a restaurant or pizza parlor, right, or something like that, is okay. I'm not going to buy in Brunswick, but there's one in Bath that's half the price. That makes sense to me, right? It's the same furniture, fixtures, and equipment. Tax returns look about the same. Why am I paying $500,000 for the pizza place in Brunswick when I can pay $200,000 for the one in Bath? Unless there's extenuating circumstances, go with the alternative, right? So that's the ceiling, is what is your alternative? The floor is the tangible assets. So if they're selling for less than the value of the assets themselves, the question becomes why? What is their motivation? And there are sellers out there who just want to be done. It's rare, right? So I always look at that rather suspiciously and try to figure out what the real reason is and what their motivation is. And then in between is where you're going to find that market price, that idea of, the cash flow should be able to support the livable wage and the debt that you're going to create in the purchase. And there might be some goodwill there, right? So goodwill, intangible value, is a frustrating concept to try to navigate as a buyer, because the seller always believes that their business is worth a lot more than you might think it's worth. And it has to do with cash flow, is ultimately what it comes down to. Demonstrable legal cash flow, which is why I encourage looking at the tax returns. Because if the historic performance does not support the value that the seller is trying to sell, then you will eventually go out of business. You will be unable to support the debt that you are putting on the business as a result of the purchase price. So that internal value of saying, okay, if I buy the business at this price, does the historic cash flow support the debt that would be created in this? Is the easiest way to see, does this work or not? Right? Is this worth the value or isn't it? Now, the idea of intangible value, customer list, policies and procedures, reputation, has to convert to a dollar amount. It has to generate more revenue than the assets themselves. The sellers can say, geez, it's cost me 2 heart attacks and a divorce. I have to sell it for this. I've been here for 40 years. If their tax returns are showing a break-even dollar amount or a marginal net income, there's no value there, right? They're not creating value with that reputation, right? So it has to convert into something. It has to be able to convert into a higher price point or less advertising dollars than their competitors, or something that is a tangible improvement to the net income. Otherwise, when you buy it, it will continue to be break even. It will continue to generate no revenue. And if you pay more for it than a break even business, you will be paying that principal and interest out of your own pocket. That idea of what you're buying, if the debt is there and the SDE is not there, the only thing that can move is your salary. That's the only other piece of this puzzle that can go up or down. So I already kind of touched on this, but you buy what it could be, you pay for what it is. It's the idea of if I'm, great at retrofitting antique vehicles, and I find, a Shelby Mustang from 30 years ago, or whenever Shelby Mustangs were. This is a bad analogy. I'm out of my depth. And it's an old beat up clunker, and it's in the a barn somewhere. I'm not going to pay for what it could be. I'm not paying for it fully renovated and retrofitted and improved. I'm paying for a beat up shell in a barn. Everything that I'm going to do to improve it, because that's what I like to do, it creates the value. And that's what I'm buying the opportunity to create it, but I'm not paying for what it's going to be. I'm paying for what it is, right? So be careful with that. It's easy to get excited about an opportunity with a business and say, geez, this is poorly advertised and poorly managed, and the owners live in Florida for 9 months and they're not paying any attention. I could get in there day one and really flip this business around and improve it. I've got all the right skill sets and experience, and this is perfect for me. That's great. That's exactly what you want to buy. You don't want to pay for what it's going to be, right? So think about this idea, like the historic SDE, right? You've got your salary needs, you've got the debt, the ability to support debt, which you can calculate pretty easily, right? Interest rates are going to be between 6 and 9%, and term length is usually like 5 to 10-ish years, 5 to 7 years, depending on the life of the equipment. We can figure that out pretty easily just from the historic cash flow. Say, okay, what's left to support debt? Here's the supportable purchase price. If you're paying for more than the supportable purchase price, that's coming out of your salary until the cash flow reaches a point where it can support it, right? So you can buy it. I'm not saying you can't, but you have to have a very clear path of how you're going to get there quickly, right? 6 months max. To say, okay, how do I get back to break even? Don't dig a huge hole for yourself. Sleepless nights, long hours, trying to get to a point where you can just support the debt, right? That's no fun. The seller took all your money and went back to Florida and is having a great time with it while you're slaving away trying to get it to where it could be, right? Should be. Pay for what it is, and then that equity piece, that should be yours to keep, right? So what about multiples? That's a common question, a common way to value a business. It's not a bad way to start, right? It doesn't consider a lot, but what it considers is it usually looks at, flipping back and forth here. It looks at the top line, total revenue. We'll talk about a multiple of revenue, or cash flow, bottom line. And be careful, because EBITDA and SDE obviously include different things. So 2 times EBITDA is a very different number than 2 times SDE. So understand what multiple you're using first and how to calculate it. Very common mistake there. Also, figure out which multiple is important for you. And I kind of touched on this earlier, but top line multiples are usually only valuable to a synergistic buyer, an attorney, accounting practice, someone buying a book of business. They're just looking at the customers. They have all their overhead already figured out. They're not worried about that. They just want to say, hey, what customers are there? So they will look at a top line multiple. Everybody else is looking at the bottom line. Expenses are going to be more or less the same, with some slight tweaks, but that multiple at the bottom line is what's left for me. What's left for me as an owner operator? What's left for me as an employee of this company working 40, 50 hours a week? Do I have anything left? Right? So sellers like using the top line because maybe their books are in disarray. They haven't been paying attention to their expenses, or they've been reducing their tax burden, for the last couple of years with a nudge and a wink. So they're like, oh yeah, 50% of my top line sales, I do $1 million in sales, my business is worth 500,000. Well, whoa. Last 3 years, yeah, you've done $1 million in sales, but you've had no profit. You've had no net income at all. So if I pay $500,000 for this business, who's paying that principal and interest? There's nothing left in the net income, right? So pay attention to which multiple you use. Pay attention to which one makes sense for you. Use the right multiple for the right tool. And it's a starting point. That's all it is. It doesn't talk about inventory. It doesn't talk about how old the equipment is. It doesn't talk about historic trends. Yeah, I've had people come in and say, okay, a 3-year average of my SDE is $100,000. And you look at the historic trends, and it was, $200,000 3 years ago, $100,000 last year, and it's 0 this year. Well, okay, yeah, a 3-year average is $100,000, but why is it going so far downhill, right? Can I say that it's going to be $100,000 next year with any confidence at all? No, it actually sounds like it's going to be negative $100,000, right? So understand that multiple is only as useful as the analysis behind it, and it's still just the starting point. So if it's a family member, if you're an employee working with an employer and you just have a handshake agreement, do the math, use it appropriately. Maybe that's a good starting point, but also understand the implications of that value to you as a buyer, right? Just because the seller says it's worth that does not mean that's the case. If all the equipment is heavily dated and you're going to have to spend $50,000 a year for the next 3 years to replace it, you have to understand that the value is going to be impacted by that. Right? That idea of SDE, right? That cash flow doesn't take into account replacing equipment. It's one of those things. Right? It could have a severe impact on the value of the business if instead of paying debt, all of that extra cash has to go to equipment replacement for the next 3 years. That debt piece all of a sudden has to be much smaller. So do that research at the starting point, at the negotiating point, but that's all it is. Rule of thumb. So structuring the deal. This is where it gets fun. Right? You go back and forth with the seller. It could be contentious. It could be friendly. We've had a lot of friendly agreements lately where, buyer and seller come to us with a price already agreed to, and then the question is, okay, how are we structuring this? They say, any business is worth $1 million if you give me 25 years to pay it back. How long is the term length? What is the interest rate? Who's actually fronting the money? So, when you're looking at tangible assets, a commercial lender is a great place to start. You've got the historic performance, you have the proven ability to support debt, and lenders also want to know what collateral is there available, right? So real estate, great, lenders love it, right? That's not going anywhere. You can't disappear real estate in the middle of the night. That is what it is. Equipment, heavy equipment, furniture, fixtures, that's great too, right? Those are real tangible assets, and the lender's thinking, okay, lender wants to know, can I trust you? What's your credit score, your down payment, your equity, skin in the game? Can I trust the business? Okay, it's been performing the last 3 years. The historic performance is there. I trust the business. You know what you're doing. What happens if? What happens if you get sick? What happens if a competitor opens up down the street? What happens if the industry changes? What they're really asking is, what collateral can I take and sell as a lender and cover my debt? Right? What protects me in that last case scenario? Real estate's great, FF&E, good. Inventory depends on the type of inventory. And understand the loan to value ratios. The idea of the lender's not going to lend the full value of something. They're going to lend a discounted amount. Because in their eyes, a $100,000 piece of real estate, if they have to take it and pay a broker to resell it, to pay the property taxes on it for that period of time that they own it, they're not going to sell it for $100,000. They might get $90,000. So they'll lend $90,000, but they're going to collateralize $100,000. So understand kind of their discount approach. Furniture, fixtures, and equipment depends on, restaurant equipment, maybe 50%. Manufacturing equipment, 70, 80%, you kind of get more out of it. Inventory depends on how new it is, type of inventory, 50% maybe. So they're looking for you to come up with the equity difference. And your personal guarantee as a buyer could have a big impact on it, right? If you have equity in your home, you have a retirement account, and you're willing to personally guarantee a loan, which is usually required, so kind of get used to that idea, then that equity comes into play here as well. It supports that consideration. There's also something called an SBA guarantee, which is either through the SBA or through FAME, which is paper collateral. So if you're buying a business that has a lot of goodwill, a service-based business perhaps, you can still create, a lendable value asset based on a guarantee. Basically, there's another organization saying, we guarantee up to 90% of this loan. And the bank looks at it and says, okay, paper collateral, right? It's we'll get 90% at least, as long as you're coming up with 10%, it covers the difference. So what happens if, right? So what happens if a bank's looking at this and they're saying, geez, it all sounds good. It looks, sounds good on paper. You're the right person to run it, but it's been break even for the last 3 years, and you're looking to borrow $300,000. So even with the collateral, we just don't see you being able to pay us back. Common conversation, unfortunately. So what if that buyer, or what if the seller wants a higher price than the bank is willing to lend to? And that's where the real negotiation begins, right? So you can offer the personal guarantee. You can have the seller hold a note, which is more and more common. Basically, you say, okay, I can finance through a bank $200,000 of this, and I need you to act as the bank for the other $300,000 purchase of this $500,000 business. So the seller gets $200,000 at close, and they get paid $300,000 over 5 or 7 years, or however much, as long as the business can support it, right? If the business can't support it, then that debt's going to sink your business. So understand the implications of that seller note acts exactly like a bank note for you and your cash flow, and that understanding of ability to support debt. But it's just a second note, and the seller has to hold it rather than the bank. There's other ways to kind of add value to it, right? So you could offer the seller an independent contractor agreement to be a consultant for a period of time, and so they get paid like a contractor, or you can offer them employment, keep them on staff for a period of time and use them as kind of a consultant, and they get paid through that agreement. If they're the landlords, if they own the real estate and you're just buying the business, then perhaps some of that purchase price is a lease agreement that benefits the landlord, right? So you say, okay, I can pay you $100,000 for this business, and I'll pay you this lease agreement for the next 6 years, which is above market value. And so now they have value coming in through the real estate, right? So there are ways to kind of add value if you can only borrow or come up with so much from some more commercial lending. That's where creativity comes into play, right? Banks are fairly fixed. They have requirements that they need for collateral, asset ratios, for lending purposes, historic cash flow presentation, and so on. Sellers, if you can agree on something that works for your business, this is important, right? That works for you, then you can get a good attorney to put it into writing. So make sure the structure works. And if it works, then you can make it work on paper. One little consideration here, 95% of business purchases that I deal with here in the state of Maine are asset purchases. And you might throw the brakes on and say, well, I'm paying for more than the tangible assets, or I'm paying for this goodwill. That's fine. It's just the way it's structured, right? An asset purchase includes intangible assets. But the way it works is you create a new company, and it buys a list of assets from the old company. So yeah, basic assets, furniture, fixtures, equipment, inventory, real estate, whatever, and whatever intangible assets you want, website, customer list, historic financials, right? That's an asset that's transferable, policies and procedures in place. But you're just buying that list. So you're not buying, whatever liabilities the old company has. Benefits, very simple, straightforward. You create a new day one balance sheet and you go, right? Downsides, if there are licenses and permits that aren't transferable, that needs to be negotiated. If there are vendor agreements that need to be renegotiated, that's part of it. The alternative is called a stock sale. The stock sale is when I would buy 100% of the ownership stock in an existing business. So it's just a transaction with the seller themselves, and they sell me literally stock, just like I would buy stock in the stock exchange. I'm buying controlling shares of the existing company. Benefits, you're stepping right into place, and you inherit, a lot of the licensing, permitting. You still have to make sure that it's transferable and that you can step in as owner, but that business exists and has existed, and you just step in as owner. Downsides, you buy the business as it is on paper, whether or not you fully understand it, right? So if the seller takes out a credit card in the business name the day before and runs up a $10,000 balance, guess who's liable for that credit card? You own the business. You own all of the historic transactions that are associated with that. So just something to kind of keep in mind, right? There's pros and cons to both. Asset is much more common because of how simple it is to structure, but things to keep in mind in that purchase and sale negotiation, that discussion. How do you treat inventory, right? How do you treat accounts receivable and accounts payable? It's important for like construction companies, plumbing, electric. Do you have 90 days of receivables out there? Does the seller get that? Do you get that? Who collects that receivables? How collectible is it? Right? If there's $100,000 of receivables on the books and the seller says that's worth $100,000, but you look at it and 90,000 of it is over a year old, well, is that really collectible? Is that worth $100,000? Are you ever going to see that? Should you pay for it? Right? So understand accounts payable is the same way, right? You say, okay, if I'm taking on this debt of the business, then am I discounting the purchase price accordingly? If there's $30,000 outstanding to vendors and I have to pay that very quickly after I buy the business, do I have the cash in the bank account in the first week to be able to pay the vendors and keep them happy? And is that just an additional purchase price of the business? Am I overpaying, or is that structured as part of the deal? So that cash flow analysis of saying, okay, I'm buying everything that's gotten me to day one, and from day one forward, where's the cash coming from, and who do I have to pay it to? That takes some additional analysis and consideration, whether or not it's a stock sale or an asset. Any questions so far? I know we've covered a lot of information. Got about 10 minutes left. So just to run through kind of some basic due diligence. One of the first things I would look at as a buyer is this idea of replaceability, right? The policies, the procedures, what is in place to make your job easy? If the seller is irreplaceable, if they are the business, then what are you actually doing? And this happens all the time, right? The seller has created 40 years. Nobody's ever used the name of the business. They just talk about the guy, right? That's very common. They do all the operations. They do all the sales. They're the face of the business. Everything they've got is up here. Right? It's all experience. That's great. That's wonderful for them. But what are you buying? Right? You're not going to be them. Okay, maybe in 40 years you will be, right? But not on day one. And if someone walks in and they expect to see him and they see you instead, they expect to see her and they see you instead, are you going to lose a significant amount of your customer base? Are people going to look elsewhere for that service just because they were paying essentially for that person? So how replaceable are they? You can ask those questions very quickly. Just, when was the last time you took a vacation? How long was your vacation? If they haven't taken a vacation in 10 years, chances are they're irreplaceable. They can't step away from the business. There's no policies, there's no procedures, there's no systems in place to monitor them, all those things when they leave. It's just them. That's who the business is. So there's still value to that, right? You still see some value. The question is, how do you get that information out of their head sooner rather than later? Is that a requirement before the sale that they put these policies and procedures in place? Is there a requirement after the sale that part of that purchase, price is an employment contract that phases them out over a period of time so that you can suck that information out of them and get all those customer relationships? If so, that's great, but make sure you get that, right? Understand how transferable it is, how replaceable they are, and how to navigate that. Because so many small businesses in Maine are really the person. And that's okay, but make sure you're protecting yourself against that day one shock of the customer walking in and saying, "Where's Bill?" and having to explain that. What contracts can be assigned? What can be renegotiated? Do they have a lease in place? Can you take that over? Do they have vendor agreements? Can you take those over? Licensing and permitting, understand what the state requires. Again, it's that idea of on day one, is the customer experience flawless? Is the customer experience exactly what the customer has experienced in the past? If it is, you've done a great job with the transfer. It's gone smoothly. If it's not, why not? What could you have done differently? So all of those little things of the fluidity and continuity of the business have to do with that customer experience and making sure that's irreplaceable. Capital equipment, is it well kept? Do they have a repairs and maintenance log? They're going to have to be some pretty heavy capital expenditure in year 1, 2, or 3, right? So look ahead a little bit. Good contracts make good partners, right? Good fences make good neighbors. If there's a seller note involved, and more businesses are transferring with a seller note, have a good attorney put that agreement together. Handshake deal is great, but the second they start asking questions, the second they show up on a Friday and want to see the books, the second they're talking to customers behind your back, right? It becomes a headache. So understand what their responsibilities are and what yours are. Set those boundaries, make it clear, and that will save you a lot of headache in the future. So it's a lot easier to navigate that now before the money changes hands than after the fact. So again, clear lanes of responsibility, identify a worst case scenario and what happens if, and then put it in writing and just make sure it's all on the same page. So if there is a disagreement, you can go back to that and say, here's what it says when we agreed to it. Do your strengths coincide with the identifiable weaknesses? Right? That idea of what are you going to create out of this business? If you're buying a business and it's already running like a top, and just firing on all pistons and you have nothing you can contribute, maybe that's fine, right? Maybe you're not over leveraging the existing business and you're just looking for some passive income and you're going to check in occasionally and keep an eye on it. That's fine, right? But if you have significant strengths, then look for a business where those are the weaknesses. If you come from a sales and advertising background, find that business where the owner operator is operational and gruff and doesn't deal well with customers. Because guess what? Putting your strengths in place there is going to do great. It's going to really take that to the next level, right? So what strengths do you have, and are you identifying opportunities to exploit that, to take advantage of your strengths and plug them into an existing business to really elevate it and improve it? Yeah, you can look, sorry, just taking a look at long-term customers, long-term vendors, long-term employees, right? All of those are good things. So you can, in QuickBooks, you can pull, a sales by customer report year by year, and you can see, is there a diverse customer base? Is everything going to one customer? Okay, that's, a bit of a red flag. It's a lot of eggs in one basket. Or, hey, it's been the same 20 customers for 5 years. Right? Everybody's happy. They're all satisfied. They're reliable. And our expectation of the future is that those same 20 hopefully are going to continue, right? There's a lot of employee turnover. If you talk to the employees and none of them have worked there for more than 6 months, why? Right? Why is that? Why is there so much turnover? What is happening? It's harder now than it used to be to identify that because there is so much tightness in the labor market. But have that conversation. Part of your due diligence, part of the asset you're purchasing, I hate to put it like that, is the employees in place. That labor capital, right? So if they're unsatisfied and they're going to disappear in the first 3 months, that asset isn't worth as much as you think it is, right? So test that. Just like looking at the equipment, you talk to the employees, walk around with them, make sure they're happy, they understand, they're knowledgeable, they're motivated. I've seen purchase prices with a portion of it contingent on employer retention, right? They say, okay, you know, I'll give you $200,000, but 50,000 of it is going to come after a year. And, you know, if 10 of 10 employees are here, you get 50,000. If 8 of 10 are here, you get 40,000 and so on. So you can negotiate that, right? It's all part of what you're buying, and putting some of that risk back on the seller, I think is a great idea. The seller probably doesn't. And if I was advising you as a seller, I would push back on it, but this is a buyer webinar, right? So, yeah, like have that risk be contingent on things, on future performance, because that helps reduce your risk, your exposure. And then build your team. Right? I can't emphasize this enough. An attorney, you know, a broker, and an accountant to kind of look over your shoulder and help point out obvious issues, red flags, concerns. The broker will get you to the close. The banker will help you finance it. The accountant will help with the financial review, and the attorney will protect you in the future. Right? The attorney's job is really, yeah, the close is important, but they're looking at the future and saying, okay, you know, are all of these documents that survive the close, the non-compete agreement, the employee contract, whatever it is, you know, the seller note, are they designed in a way to reduce your risk as much as possible? So, you know, common timeline, just throw it out there. So confirm interest. You know, if you have a seller in mind, if you've already been discussing with them, they might make you sign a confidentiality agreement before they kind of show you the books. That's fine. Understand what the implications are there. Who you can share that with. Most confidentiality agreements have a clause that allow you to share it with a specific team. So you can share it with your accountant, your attorney, you know, your small business advisor, whomever. And then you can put together what's called a letter of intent, which outlines the terms of the sale. Very similar to kind of a purchase and sale contract. It says, hey, I'll buy this, assuming I can get these contingencies fulfilled, right? Just like buying a house, most purchase and sale agreements, letters of intent, have a financing contingency and a due diligence contingency. The financing contingency should outline how much you expect to borrow and a cap on the interest rate, right? So they can't come back and say, hey, you could have borrowed $100,000 with credit cards. And you say, well, I guess technically, right? But no, your cap is 8% or 9% or a 7-year term, right? And then the due diligence contingency, much like a house, you know, due diligence, buying a home, should cover every form of inspection: financial review, employee review, policies and procedures review. So just understand those two contingencies have a deadline, and they give you a period of time to fulfill the contingency or discover something that you're not comfortable with. Discover that some of the bookkeeping is questionable, or discover that the employees have all left, or, you know, discover that you can't finance it, that nobody's willing to lend to you. So give yourself enough timeline to fulfill those contingencies and either back away and get your earnest money back, or continue forward to the purchase and sale. And you can renegotiate, just like buying a house, right? If you dig in and you discover that the assets aren't as disclosed or what you expected, you might still be willing to pay for it, but less. That's fine. And then work with your attorney to kind of identify the documents that survive the close, right? If there's a non-compete agreement in place, the employee contracts, seller notes, whatever it is, just make sure that there's paperwork and a contract in place that kind of navigates the ups and downs of each of those. So list of common due diligence items I threw out there. Some of these may or may not pertain to all of your businesses. I look for at least 3 years of tax returns. If you can go 5, that's even better, especially with COVID doing what it's done. And then a year-to-date set of financials is really helpful. Say, okay, closer to 2020 or 2018, 2019? Right? Are they recovered to pre-COVID, or are they still feeling the impacts? Will they ever recover? At this point, it's a legitimate question. If they haven't gotten back to 2018, 2019 levels, or plus or minus 10%, have they adapted appropriately? What changes have they put in place, or what does the industry look like as a whole? What you're buying could be entirely different from what it was 3 years ago. Org charts, sales by customer, reports by year, we talked about that. Inventory, AR, AP, what will it be at close? Minimums, maximums. You can require that they pay off all the vendor debt at close. I'm going to buy this business, vendor debt has to be 0 the day of close. And part of the purchase price is going to be allocated against that to make sure that gets done correctly. Contracts, equipment leases, all of that. It's just understand what you're buying, make sure you have it free and clear, and you can keep that customer experience as fluid and contiguous as possible. Because you want all of that historic performance that you're buying, the policies, procedures, everything else has to be as contiguous as possible. You have to buy it in a way that the customer doesn't know any difference from before you purchased it and after. Now, all those improvements you plan on making, that's great. That's what you want to do, but you don't want to be running around putting out fires and solving issues that could be solved now. Yeah, so I think that's all I kind of had to cover. We're a little over time. Sorry about that. Let's see. So a couple questions
There
came
is
in.
one question, yeah. What is considered high turnover in a service business since COVID? Has the definition changed in the past few years? Yeah.
It's definitely changed in the last couple of years. I'm hesitant to tell you like, oh, it's 6 months, it's 3 months, it's 9 months. It's almost by feel. You'll have to just kind of go in and see where they stand. You could ask too, what was your turnover pre-COVID? There are ways to kind of put sellers love to complain about their employees. So don't be afraid to kind of like, oh man, the labor market's tight. How are you handling it these days, right? Questions like that often elicit a great response, and they don't put the seller on like a defensive trajectory. So don't be afraid to just ask, but make it frank, make it honest, and give them the chance to answer. Well, sorry, not a good answer, not a specific number in mind. But so valuation multiple is 15-year company with EBITDA of 500,000 and gross of 4.6 million. So multiples are very dependent on industry. So a multiple of a manufacturing company is much higher than a multiple of a service-based company. Restaurant multiples are very small, right? Tight margins, high risk, low success rate. So even saying a 15-year company with EBITDA of 500K, top line of 4.6 million, it depends. Is it a medical practice? Is it manufacturing? How many assets are there? I would also say, so typically, businesses doing less than $1 million have much smaller multiples, which is counterintuitive. You would think that, okay, a smaller amount times a smaller multiple is much less. But you have to think about it like risk, right? Any kind of a business purchase is a risk-based. You're trying to predict future performance. So larger business, 3, 4, 5, 10 million, right? That has those policies, those procedures, that long customer list, that long performance. So people are paying higher multiples for that. So it's an exponential scale. Say I'm paying a higher multiple for a higher amount that I'm multiplying it by. Because I can spread my return on investment over 10 years reasonably, or 8 years, rather than needing it in 2 or 3. Does that make sense? Any other questions? People want to chime in or hop off?
We're just mostly just getting thank yous. I got a couple private messages. A couple people had to jump off. So definitely thank you, Raynor. Thank you to everybody else who joined us. Like we said, this was all recorded, so I'll be sending out a follow-up email. So if there was any of that sounded like gibberish to you, you can rewind it and re-listen.
Sorry, just to hop in, I scrolled up and saw another question. If you have a specific question about looking at an acquisition opportunity, please reach out. We do a lot of one-on-one help, and we'll be able to better answer your question when we can kind of dig into your scenario. So, sorry.
Yeah, no, that's a good point. Like we said earlier, our one-on-one advising is really the meat and potatoes, so to speak, of what we do. So if you've got complex or just questions that seem complex to you and you're not sure, we are happy to help. So I'll include all of our contact information as well as Raynor's contact information in my follow-up email. And we hope that we'll see you at the next event. Everyone's saying thank you. Super helpful, very informative. So well
Enjoy
done.
this weather. Thanks, Kelsey. Thanks all.
Awesome. Have a good one.